What's going on, everyone? Charlie here. So, as you all know, been vehemently, if that's how you say it, vehemently working on this Title 12 banking sector stuff over the weekend. It's pretty crazy because, number one, we have disclosure requirements for the first time as far as between the banks and the regulators. We also have public disclosure. So, this is huge. And now, the things they have to disclose is what we're going to be looking at next, and it's all comprised in the ASF and the RSF thresholds. So we're going to look at the ASF in this video and break down what makes an ASF factor 100% versus 95% versus 90%, etc. Now, the higher the percent, the more reliable the funding. The lower the percent, the less reliable the funding. So the key here is to see what category or what asset/liabilities are they going to be able to use to inflate their books, if anything at all. So real quick, 249.131, brand new section in this part of the Federal Code of Regulations. So general, a covered depository institution holding company, U.S. intermediate holding company, or covered non-bank company must publicly disclose the information required by this subpart in the format provided in Table 1 to this paragraph. Now Table 1 is right here. For the purpose of this video, I only have the ASF items on here. There is a lot more that must be reported, but for this video, we're just going to cover the ASF items and what makes each threshold reliable or not reliable. Now, of course, the ASF and RSF are two important factors, or two important percentages that derive the new net stable funding ratio, which must be at a weighted average of 1.0 for all of these banks. Otherwise, bad things could happen. So let's go ahead and take a look at what makes the ASF reliable or not reliable. So an ASF factor of 100% or reliable funding. Again, new section. NSFR regulatory capital elements and NSFR liabilities assign 100% ASF factor. An NSFR regulatory capital element or NSFR liability of a board regulated institution is assigned a 100% ASF factor if it is one of the following. An NSFR regulatory capital element, which only means it is a capital element included in a covered company's common equity, Tier 1 capital, additional Tier 1 capital, and Tier 2 capital. So I'm assuming it's cash on hand. An NSFR liability that has a maturity of 1 year or more from the calculation date, because ASF is a measurement for 1 year of reliability, and is not described in paragraph D9, which paragraph D9 just says that a ASF factor of 100% cannot be 100% if it's 50%, obviously, and it can also not be 100% if it is a liability owed to retail or a counterparty that is not a deposit and is not a security issued by the board institution. Now, NSFR liability is basically, all that means is it's anything that's not a capital element. So ASF factor of 95%. We have some newly defined terms in here. Basically, the key takeaways from here is for an ASF factor to be a 95%, it has to be a stable retail deposit regardless of maturity or collateralization held at the institution, or a sweep deposit. Now, a sweep deposit is just a deposit held at the FDIC supervised institution by a customer counterparty through a contractual feature. Basically, insured accounts. Now also, it has to be entirely covered by deposit insurance. So as you can see, to get that factor of 100% or a 95%, you have to have reliable funding. It can't be uninsured, bad assets. It's got to make sure it has value in it. So that is good to see. And then also the board regulated institution demonstrates to the satisfaction of the board that a withdrawal of such deposit is highly unlikely to occur during a liquidity stress event. So in the case that they have an event such like this, they don't want unreliable funding, because if they have to tap into it, you can see how that could get bad. ASF factor of 90% would be a retail deposit regarding of maturity or collateralization, a brokered reciprocal deposit, which actually was just defined. Brokered reciprocal deposit means a brokered deposit that an FDIC supervised institution receives through a deposit placement network on a reciprocal basis, such that for any deposit received, this was newly added, the FDIC supervised institution as agent for the depositors, places the same amount with other depository institutions through the network, and each member of the network sets the interest rate to be paid on the entire amount of funds it places with other network members. So crazy stuff right there. Now before, check this out, broker deposit, the terminology before says from or through the mediation or assistance of a deposit broker, as that term is defined in Section 29 of the Federal Deposit Insurance Act. And then they took out this sentence, and includes a reciprocal broker deposit and a brokered sweep deposit. No, it just says and the Federal Deposit Insurance Corporation. So it seems to me like we're skipping the broker dealers and we're going straight to the regulators and we're taking out the middleman. This could be huge. Yeah, tits already jacked. So ASF of 50%. Now I'll let you pause and read this if you want. The main thing I took away from this is that a 50% factor was going to be a NSFR liability owed to a retail customer or counterparty that is not a deposit and is not a security issued by the board institution. So that sounds like shorts or share lending would fall under the 50% category, or only to be available for about 6 months. Now, a factor of 0%, check out number 1, a trade date payable that results from a purchase by the board regulated institution of a financial instrument, foreign currency, or commodity that is contractually required to settle within the lesser of the market standard settlement period for the particular transaction and 5 business days from the date of sale. So FTDs, tits jacked, don't know, but yeah, you can see everything's highlighted in green because it's all new added language. So this is just 1/3 of it. Okay, so next video I'm going to show you the RSF factors, what makes up those different thresholds, but they're definitely trying to categorize their funding, their collateral, whatever you want to call it, to see the value or the tier which will fall under. So it's crazy to see all this happening. So hope this helped. I'll go make the RSF next. So to reiterate, if you want reliable funding, you cannot use shorts, FTDs, share lending, rehypothecation, at least based on what this is saying. So the question is, will it be enforced? That is always the question. So hope this helped. I'll bring you the next one here in just a little bit.